Most entrepreneurs do one acquisition in their lifetime and spend years recovering from it. Today's guest did over 24 and used each one to reshape an entire industry. Jochen Engert co-founded FlixBus in Munich in 2013. Within 2 years, he and his co-founders merged with MeinFernbus, their fiercest rival at the time, creating the dominant German network almost overnight. In 2016, they absorbed PostBus and Megabus's European operations, taking their German market share to above 80%. In 2019, they bought Kâmil Koç to enter Turkey in a single move. And in 2021, during the global pandemic, they acquired Greyhound, a 107-year-old American icon, and set about transforming it. A merger with an equal, an absorption of a weakened competitor, a market entry by acquisition, a turnaround of a legacy business on a different continent. For ETA operators, this matters more than it might look. The scale is different, but the human and operational problems, as well as the strategic considerations, are not. A local competitor circling the same customers, a bolt-on that doubles your capacity, a neighboring market you could enter by buying instead of grinding. Who leads, who steps back, and what do you tell your team when? These questions are identical, whether the deal is worth 800 million or 800,000. Jochen, welcome to Lineage. Jochen, most first-time CEOs inherit a business and immediately face a competitor in their market. The instinct is to fight. You repeatedly chose to acquire instead. How do you know whether to compete or to buy?
I think it's the underlying and fundamental question of if and when to do M&A. Yeah? So, I mean, in our case, in our industry, it's just very obvious that there's so much synergies in consolidating markets that it's always been very clear for us at the beginning that at some point you need to drive consolidation, be it either through organic growth and basically penetrating a market deeper and just winning market shares against competitors, or through acquisition. And ultimately then it comes down to what's the right timing for an acquisition. Because we've basically, if I look at our markets, in most of the bigger markets, we have done M&A somewhere along the way. And so for us, it was pretty obvious. I don't think this is the case for all the companies. And I think there's always this trade-off between, let's say, all the hassle that you go through with M&A, with the complexity of the deal, finding that the right structure, investing that money upfront effectively, and then obviously the uncertainty within integration, versus to buy or build. And build, I think, in terms of organically growing is always an option. At the same time, I always have the feeling that people shy away from acquisitions because they don't really know what they're getting themselves into. And I think this is a mistake. I think there's huge value to be created in M&A if you do this properly. I think not enough people are doing it. Not enough people are sort of taking the courage to get a deal done and try it out. And I think that there should be more openness, especially in situations like in your portfolio and like in your network, like with entrepreneurs that are sort of starting there and have this opportunity, and where there's a strong market logic underlying, where you feel there must be synergies, where you just have this. I mean, it also often comes down to a gut feeling. There needs to be synergies in if we combine the businesses. If you have this gut feel, then you should at least spend the time, invest that effort.
Now, for a small operator, succession entrepreneur, first-time CEO, what does it actually take to walk then into a competitor's office and propose a deal? Like, how do you start that conversation without giving away, leverage your position?
I mean, again, here, if I look back at our first deal, we've also been a bit reluctant in terms of how do we approach them? Do we give away leverage? Should we make the first move, or should we wait for them to make a first move? And in our case, this was MeinFernbus back then. We decided to send one of our shareholders actually to basically start a conversation with them, to also have a bit of a fallback option in terms of if they kind of laugh at it, then we can always say, it was his idea. We never thought we should be merging or buying or like cooperating. So we would always have that fallback. So this was our way out of this trap, sort of. So I think, and this is actually quite interesting instance, because I think it's always helpful in M&A situations and also in negotiations to have something like a fallback layer. So basically create different levels of the discussion, like an operational one where you actually do the deal, but also fallback layer in terms of a shareholder discussion, let's say 3 steps back type of discussion through this, maybe advisors, maybe external people, like someone that has a backdoor somehow to kind of mitigate certain complicated discussions, to moderate conflicts, etc. I think this is super helpful, and this was our way of doing it. Ultimately, I mean, looking at the other deals that we've done, and it's been a lot. Like over the years, we've done two dozen deals or so, like a few bigger ones, but also many smaller ones. It's always been a situation where we try to get in discussion with other players in the market very early, like build a relationship, because usually M&A situations, I mean, there's some that happen through, let's say, a structured process where companies are put for sale and there's a structured process, there's different bidders and stuff. To me and my experience, most deals actually happen through a long-term relationship building. So I would encourage everybody to just sort of have an open discussion with other players in the market, even with competition, to exchange. There's always stuff that you can potentially do together and where you can cooperate. And for us, it's also been lobbying on the regulatory side in many cases and like other things. And I think it's always been helpful to have an open dialogue and build a relationship early. And that makes it much easier and basically also lowers the hurdle to engage into an M&A discussion at some point.
I mean, we will get into kind of the deal process in a short while. Before that, when you talk about mergers, you always think synergies, right? And in the case of when you merged with MeinFernbus 10 years ago, it was not just about like revenues, it was about routes, route optimization, overhead optimization, creating or reducing the network density. How do you quantify synergies? Do you have a framework for that? How should an entrepreneur think about that when or before actually entertaining any sort of acquisition/merger?
Yeah. I mean, I think ultimately, of course, the synergy part is the key part of a deal. Like if there's no synergies, that to me, it's always very difficult to make it work. If you just sort of rely on, at some point, there will be multiple arbitrage because we're a bigger business or so. I don't think this is enough. I always feel there needs to be operational synergies. And obviously this can be either revenue or cost-wise. And ultimately you go through your P&L and basically every line item and look into where could we have synergies? Are we going to be strong on the market and are able to command higher prices? Are we going to be having a more effective go-to-market approach in general? Are we saving on market spend? Do we have overhead synergies? Is there some back office stuff that we can optimize? Is there other operational things where we can have a leverage? In another case, for us, it's always also been typically a lot of IT synergy. So we basically put everything on our system and dropped the sort of target system relatively quickly. So lots of synergies on the tech side. So I think you ultimately, as the founder, operator, CEO, leader of a business, you will have a very good feeling of where could synergies be, like in the first place. So you will have a strong gut feel in terms of this is the 3, 4, 5 topics where I should be looking. But then I think it's very important to really also build a very robust case for yourself, a business case and a synergy case. In terms of where you think the synergies are in real life, you need to quantify them. And then I think it comes down to working with sufficient buffer in terms of not being overly optimistic and rather be positively surprised versus getting negative surprises along the way. But I think you need to absolutely build a very strong case. And then it comes back to your make or buy decision in the end. Is it more efficient to allocate capital into an acquisition? And are the synergies big enough, even in a, let's say, conservative base case? And if you have that feeling, then I think it's the time to make a move and really progress with a potential M&A situation and like start a deal conversation and try to get a deal done.
You mentioned revenue, cost, IT synergies. In your experience now, looking back, what synergies worked better?
I mean, in our specific case, the big lever has usually been the market consolidating. So the revenue side of things. So basically being more efficient on the supply and demand matching, having like the right level of supply with the sort of existing demand levels, being able to drive utilization and price realization up. This has been the big levers. I guess the simpler ones are the cost items usually. I mean, talking about IT, this is relatively straightforward in terms of looking at what's the target's IT cost, how much can we save if we just pull over our own system. This is relatively straightforward math and easy to quantify, and also relatively easy to ultimately catch post deal. That's pretty technical. You just need to get the stuff done. You just need to build a few features maybe, and then manage the transition. But this is relatively easy to make it happen. On the revenue side, in our case, you always have a bit of uncertainty in terms of how is the market going to react? Is there potentially other competitors moving in, changing market dynamics to some extent? So I think this is something where you'd rather take a more cautious approach and build more buffer. It's usually taking a bit longer until those synergies come into play. And this has maybe been one of our learning. I guess at the beginning, we've been too optimistic in terms of how quickly we can get the synergies realized. Our plans have not been too optimistic in terms of how big the potential synergies are in terms of like total magnitude, but the timing has not been great for us in terms of when we thought we could actually realize them. So I think this has also been a learning for us over the years to say, well, let's rather be a bit conservative how long it actually takes to adapt the IT system, to kind of build a joint organization, joint operating model, and really sort of be able to create back office synergies, how long it takes to adjust network, adjust prices, be more efficient on the marketing side, and like really leverage the joint customer base. Like things like that usually take a bit more time than you would wish for. Again, rather be on the conservative side in your planning and get an upside surprise if it ultimately happens.
So take the base case and then, either adjust it by 30% down / longer.
And I know we're kind of, I think we're jumping a bit into how does integration work and stuff, but you'd usually underestimate how long it takes to really understand the target in detail, because there's always a difference between the diligence phase when you look at a target and you try to analyze it and try to get a deal done, and the level of data and understanding and the depth you have into a business. I think you can get a very good understanding on, is this a great target? How do the financials work? Is there synergies and what do I need to look for? And like all the P&L and balance sheet and whatnot, that's doable. Like the nitty gritty details of a business, the operating model, all the stuff that you don't see, that's not explicit. This is costing you time to really spend time with the team on the ground, really understand it in detail, all the nuances of the model. This is something that, and I would also advise on spending time in the first 2-3 months or so to really understand this in detail before you make your move. And I think there's some low-hanging fruits that are easy to execute on, and you should do this right away. Like the earlier you save, the better. But there's some stuff where you just need to have enough understanding of the business and like all the details of it until you really decide on what's the future operating model. Maybe do we adjust our product to some extent? What's good on the target side? What's good on our own side? How do you make the best of both worlds out of it? Like take your time there and sort of don't rush into things. And you'd usually underestimate the time that it takes to really understand this in detail and really get this full comprehensive understanding.
And you're right, the integration part is something we want to touch base on in a bit more depth. And you're also right that it doesn't matter whether you buy 100 million euro revenue business or a small couple of million revenue business. Only after you've been in the business for 6+ months, you actually find out what you acquired / what the business actually does. So there are quite a few similarities. I wonder if before we go to integration, you obviously need to kickstart the process. Most first-time CEOs have never run an acquisition. What does it typically take to run a process? What are the stakeholders involved? How would you structure it?
I mean, again, I think it's very specific to the situation of the company, to the target, to the shareholder structure. Who is this? Like, who owns the business? Who's the decision maker? I think first step is you need to get the ultimate decision makers into a room, get them together, and also get chemistry working to some extent. And again, coming back to our learnings or my learnings along the way, a deal is never something technical. A deal is always made between humans. It's always made between 2 or more people, like ultimately human decision makers. So this needs to work. There needs to be a certain level of trust between the decision makers. There needs to be a certain level of sympathy. Like they don't need to be best friends or something, but there needs to be a certain level of sympathy. If you hate each other, it's just really difficult to get something done. And if you feel like there's just not that chemistry where you can somewhat speak openly and build some sort of a trusted relationship over a certain period of time and over a certain sort of course and sequence of events and meetings and discussions, then it's really difficult to get something done. So I think this is the first step to really get the decision makers together, build that sort of trust base, and then really get into at least a high level conversation on how big is that business, how is it doing, like a few rough KPIs on the financials to get an understanding of how big is it, how attractive is it, and what could be a valuation range roughly, to have an understanding of, is there something where we can make ends meet? In quite a lot of situations, the expectations are just very different in terms of what a buyer would be willing to pay versus what a seller would be asking in terms of a price. And I think, again, if you have a trust base, it's much easier to have a candid conversation in terms of, hey, this is how we look at it. And this is where it usually gets very emotional. And especially, I guess, in like these types of entrepreneurs that you're working with, for them, it's their baby, right? It's their life's work. This is very emotional, and you shouldn't underestimate this. And I think that there always needs to be this appreciation of the other party's work, the value they created, the quality of the business that they've built. And at the same time, you need to obviously rationalize it to some extent in terms of objectively, if I look at it, this is how I see the financials. Please correct me if I'm wrong, but this is how I see your profitability, cash flow profile, whatever is relevant. And if I look at market benchmarks, if I look at an objective way to value such a business, this is where I would end up. And then you'd usually come up with a range to some extent. And then at some point, you need to have a conversation around, this is a range that we could see. Do you see yourself too at that range to actually be able to sell the business? And then have a commercial discussion. And I think this is probably the most crucial part of it. You ultimately need to have a trust-based handshake with that other party on the rough commercial framework and deal parameters that you want to execute on. And this is the part that's the most exciting one, but also probably the most difficult one to get to, because again, ask and bid can have a big spread, and like expectations can vary quite a lot.
Do you have any tips, ideas, like who you want by your side when you do those negotiations? Do you want to do it yourself based on your experience? Is it good to have somebody by your side? If so, who, to basically make the negotiation go well?
I mean, coming back to what I said earlier, and people have different strategies here. I always felt it's very helpful to have a fallback layer, some moderating layer where you can potentially also take certain conflicts or disagreements too, that kind of helps rationalize a discussion again. Because as I said, I think many of these discussions get emotional relatively quickly, especially if owner talks to owners. Then I think you want someone on your side that has some sort of an authority in the industry, some sort of a natural authority that also the other party would appreciate, that can help, that doesn't completely feel like he's on your side only and only pushes for your objectives, but that does also that sort of different level that helps moderate such situations. And I think if I would also be in a position, I'd always also ask the other party if they could bring someone like that. This can be a lawyer, this can be an accountant, a tax advisor that they've been having a trusted relationship for a very long time, that's somewhat rational in those situations. And I've seen different setups there. At some point we used people from our board, we used industry experts, we've also played good cop, bad cop in some situations, like me and my co-founder, so that you always have at least two people that you can play different roles. And I think this role play thing is something that's super helpful in negotiation situations. And you should actually deliberately build the setup in a way that you can play those roles. And playing roles sounds a bit negative. It's actually positive, because I think you need the roles to be able to manage those emotional conflicts and potential disagreements along the way much better. And this can be good cop, bad cop. This can be the senior guy that helps it rationalize again. This can be just a moderating level where someone says, okay, this is emotional, let's just take a break. Just like very simple things to kind of navigate those situations. But as I said, I'd strongly advise to at least have one person. Let's say it's an owner to owner. You'd at least have one person. This can be someone external that at least that explicitly has this job of, hey, let's moderate this discussion. Let's make this as rational and as objective as possible in case this gets out of hand and emotional and there's big disagreements and potentially derailing the process.
Where would you not save money on in such a process?
I've always been cost conscious too, and I think we're very frugal as a company in general, and very we don't like spending money on advisors. Let's put it like that. I guess just like most. I think it's also a question a bit of where's your risk. So I think you need to look at the business, at the deal, and see like where's my biggest risk, and what type of risk do I basically want to buy an insurance for. So if I feel like there's a strong risk on the legal side, there's some sort of legacy issues in the business that I need to be that I need to have some sort of a waiver for, some sort of insurance, then you'd rather spend money on lawyers to make sure that this is waterproof and they actually find every detail of any potential problem. If the target doesn't have to have financials and accounting in order, then you'd rather spend a bit more money on the financial diligence and like have an external accountant and advisor look into it in detail and and really build an external, objective, and professional opinion on it. Also, if you don't feel comfortable with that yourself, I mean, also depends on your background. And I guess your own background, the deal situation, the target situation, let's say the DD readiness of a target is impacting that a lot. Like the more professional a DD process is prepared, the better the data room, the more transparency you have, the less insurance I guess you need to buy. If there's only little data, little information, then I guess you'd rather buy a bit more insurance and pay a bit more for advisors here and there. So again, very specific to the situation, but you need to be conscious of where's your risk and what kind of risk are you willing to swallow and just take from an entrepreneur perspective versus what are you not willing, and where you'd rather spend a bit more on advisors to basically buy this insurance.
And insurance is a nice segue into another form of insurance, which typically is part of a M&A transaction. We talk about earnouts, seller financing, deferred payments. You want some sort of skin in the game. Which structures, based on your experience, have actually worked to align incentives and which have rather created problems?
I mean, I guess strongest alignment of interest is always co-ownership. So if you buy someone, something, some business, and the former owners roll into a joint group, that's always a very strong signal and creates a very strong alignment of interest. You got to be aware that in any of those deal situations, as aligned as this may seem at some point along the process, you will always have a certain disalignment of incentives. You'll always have one or the other party trying to optimize for themselves a bit more here and there. This is always the case. This may be on the head financial terms, this may be on the warranties, this may be on the integration phase, this may be on earnouts. Like somewhere there's always going to be a disalignment. And again, here, I think you need to look through what are the big items. What am I willing to accept in terms of maybe I pay a bit more or I take a bit more risk and it's fine, I can swallow that, versus what's the really, where does it really count? And I think this is also how you need to build your incentive systems. And again, rolling into joint equity is the strongest alignment of incentive. I always felt like a deferred payment in terms of there's always this carrot of, oh, this may be at risk is something that's very valuable. And then you can discuss, is this 6, 12, 18, 24, 36 months or whatever the time period. I think the longer you can stretch it, the better. This shouldn't be forever. I think everything that's beyond 24 months is probably unrealistic because at some point, if you buy something, you're responsible for it and you take ownership and there's only a certain interim period for it. But I think this is true too. On the earnout side, I think this may make sense in many cases too. I always felt many of those setups that I've seen and have been proposing and been proposed and like seen in other situations are way too complicated. People try to mitigate and manage for every single eventuality and every single edge case and build very complex earnout systems and schemes. I think this doesn't work. I think this needs to be very simple because what you don't want to have is that you actually have a well-running business, the integration was successful, it's all gone well, and everybody's happy in general, and then you have an argument and a big fight about an earnout, and like we've had different definitions of a KPI and stuff like that. I think this is very painful, and ultimately also doesn't serve the course. So I think you need to build something that's relatively simple and straightforward, and where you have very sort of room to even argue about a definition of a KPI, like the ultimate outcome of an earnout. I think this needs to be very clear and as simple as possible.
What KPI would you base it on, or what has worked well in your experience to keep it as simple as possible?
I mean, again, I think it's very specific to the deal situation. This can be revenue targets, this can be profitability targets, and this is, I guess, the key major ones. So this is the typical ones. If there's other stuff that's just very critical in terms of retention of core team members, it's a sort of technology transition or transformation or whatever there may be, then I think you need to put this down too. This is all much more difficult to track and ultimately hold people accountable for. Everything that's related to business case and like certain milestones that you need to achieve on the revenue or cost or synergy side, I think that's doable. Everything else is complicated, but I think it's a fair mean to also, again, align incentives.
Now, on the diligence side, right, you've agreed on a price based on a couple of dozen transactions you have done. What would you say is a thing that diligence almost always misses or pays too little attention on?
Yeah, I mean, as I said earlier, you only get to know a business once you own it for a few months at least and really get into the details. This is almost impossible to get in the diligence phase. I think one thing that I'd probably do today that we haven't done enough in the past is talk to the second line management. And I mean, depends on the size of the business, but like talk to as many of the team as possible to get a feel of what's the culture, what's the mindset, what's the general atmosphere in the business? Where do people see problems? Are they negative? Are they concerned? Are they optimistic? Are they bullish? Are they working together? Is it cooperative or not? Just get a better feel for the organization itself. This is something that no advisor, no sort of finance guy, no legal guy will ever even be able to tell you. This is something where you need to get a feeling yourself, and where you actually be surprised how much you learn. I think you probably learn more in talking to 5 to 10 people from the organization from different departments and like very different areas versus spending another 3 days in the data room and digging through documents.
I want to ask one specific question with the idea of expanding in your core market versus entering a new market. By MeinFernbus, you merged with a competitor in the same market, but you also expanded into Turkey by acquiring a competitor, into the US, taking on Greyhound. How was your diligence and also the investment case different? Where were you basically a bit more lenient, more optimistic?
I mean, our Turkish deal, so the acquisition of Kâmil Koç, was very untypical for us, actually. We didn't have a business on the ground. We had one person that we hired to start building Turkey as a market for us, but we didn't have anything on the ground yet. But then there was this opportunity of buying Kâmil Koç, and in our case, we decided for it because the market structure was in a way that you basically had 3 larger players, and 2 of them you couldn't really buy. It's like impossible to diligence, complicated structures, whatnot. And Kâmil Koç was private equity owned, so this was the only one target that we could actually buy. They put it up for sale, so it was a bit of a timing topic too. So we just had this opportunity and felt, okay, we want to go into Turkey anyways. I feel it's a great market. And if this business is up for sale and we feel it's the best and most professionally managed, then we should absolutely have a look. But this was very, very untypical for us. We'd usually always try to build an organic footprint in the market first, really understand the market in detail. And I think this is the part that was most complicated in Turkey. To buy a business of that scale, it was effectively the market leader already with like 20 million passengers, so it was pretty big. And we haven't really understood the market fully, like in terms of the regulatory environment, how would politicians look at it, etc. So we've done a lot more work on the market structure, the dynamics, the regulators, and everything around it than we would have in any other deal situation. Spent much more time, like talk to government officials and talk to other players in the market, lots of other stakeholders, and like spend more time and money on that side of things. Versus the rest of the process was pretty much straightforward, typical Flix diligence that we would have done on any target. But this part was more of, again, we looked at what's our risks in that scenario and what do we need to manage and mitigate. And this was then ultimately where we spent more time and money.
Is there like a market entry premium you pay in such situations?
I think sellers will always try to command a premium for strategic buying a very specific asset. If they feel like this is a unique asset, they will always try. And I think this is, again, where you need to be disciplined. I guess this is a general advice. You just need to be very disciplined on M&A deals. You shouldn't be getting torn away by, let's say, the deal dynamics and like deal fever. The further along you've been dragged in a deal situation and the more time you've spent, you feel like, oh, I've spent so much time right now and so much effort and money and whatnot. I need to do this deal just for the sake of doing it. But I think at every stage, you need to ask yourself, is this still the right deal? Does it still make sense? Is it financially the right thing for my company to do? And I think this discipline is just very, very important. And again, another learning along the way, there's almost, I would say, no point in time where you cannot reopen the deal terms. So if you feel like you found out something new, whatever this may be, market dynamics, regulatory change in the business, some dead body in the basement that you've seen in the data room, whatever happens, you can always reopen the deal teams. If it's not sort of very last second where you basically had done it and agreed already, but like there's always room to kind of maneuver. And from the reaction of the other party, you can also see if you're rightfully opening up the deal terms again. And they kind of have an understanding on why you do it versus they're going to be completely pissed and just break it up. And if they break it up, then it's probably also good to just not do the deal ultimately. But again, I think this discipline of staying rational along the way is just very, very important.
For an operator now running the first acquisition, they also have a day-to-day job. just realistically speaking, if you decide to go down that route of taking over a business, how much time do you need to dedicate? What's kind of a realistic expectation that somebody should have?
Yeah. I mean, if you do this the first time, this can be a full-time job. Let's be clear. You can. It's also a bit of a question in terms of what time frame do you need to have to do such a deal? Is there a deal dynamic where there's other bidders and you absolutely want to get it done and you got to rush to sort of do your work and stuff, or you have a bit more time? I guess in most of the situations that you're looking at, there's no immediate need for the target to sell, so you will have a bit more time, and there will be an understanding of, hey, I have a day job too, and I need to at least like half the week look after my day-to-day operations. I mean, I cannot sort of sit down with you from Monday to Saturdays, morning till late, and so I think that's clear. But again, in like the hot phase of the deal, when you sort of at the late stages of the diligence or the deal making itself or the contract work and stuff, this is going to be commanding a large part of your day and week for sure. And it should be, because if it's a big deal, it's a potential game changer for your business, you should spend the time. But at the same time, what this tells you is that you need to have the rest of your house in order. So you need to have a well-running operation. You need to have people that you can rely on that sort of keep running your core and own business while you're away, basically. It's a little bit like being on holidays and not answering the phone. You need to be sure that the rest of the business is actually working, because you can't be firefighting on all ends. You shouldn't be doing complicated M&A deals in situations where the rest of your business is on fire. That's just really, really stressy. We've tried to eventually obviously build a very strong management team that we could rely on, and also build an M&A muscle, because we figured for us, M&A is going to be a key part of our growth strategy. We will be doing it along the way. There will be deals pretty much every year. So we built a lean but mean internal M&A team. So folks that have controlled most of the process, have done most of the diligence work ourselves. So all the commercial diligence we end up doing ourselves. A little bit of finance and legal here and there externally, but like most of the work we've actually done ourselves with internal folks. And this has been our way of doing it and been very effective.
And I think for like a small business entrepreneur, you don't need to immediately hire someone, but maybe start with one person to allow you to support you on that specific work stream while you take care of the business.
Yeah. And also, I mean, you can be creative around how you sort of solve this additional workload. You can hire a freelancer for a certain period of time when you're in that deal that helps you with the diligence part of it. Someone that you trust, maybe some ex-consultant or whatever, that you can hire and basically is your wingman to do the diligence work and works very closely with you. So you can be creative in that if you feel like it's worth it, and you want to spend that money and you want to just get it done effectively. Absolutely.
Which is a nice segue to kind of the human part. You said it earlier, it's a people's transaction on all levels. Across the 5 deals that or across the dozen deals plus that you've done, what broke first on the human side of the transaction?
Yeah, I think the easy part is basically building a milestone plan on this is what we do in the integration. That's a different sort of corporate functions. This is the steps that we do. This is the measures that we're taking. You build KPIs, you build deadlines, you build responsibilities. That's the easy part. So you can just put this in a spreadsheet or in whatever tool you want to use. This breaks where just people meet people. And a buyer's team meets a target's team, and this may have been a competitive situation in the past, and they may have been hating each other for a while, which was in our case true. Like MeinFernbus was our fiercest enemy back then. Few people will remember, but our brand was blue and they were green, so our team was bleeding blue and they were bleeding green. And eventually, at some morning, we told them, "Look, this is our best friends now. You're one team," and this was very surprising. So this culture shock is something that could happen. In many cases, actually, it does happen to team members. There would be this level of uncertainty also, because with a lot of people associate, okay, there's going to be synergies and there's going to be redundancies and we're going to fire people, and who's going to be this? And is my job going to be here tomorrow? And what's going to happen to me personally now in this situation? And I think you need to answer this. So I think you need to have a very clear communication strategy. And again, this is something that we've probably underestimated. It did take care of it and spend a lot of time, but you cannot stress this enough. You need to have a very good communication strategy. You need to be in touch with the team on a very regular basis, be very open and transparent. Try, again, the same trust relationship that you had with the owner, you need to build with the team. And I think this needs to be part of the operator CEO's agenda. Build trust with the team, period. and like make this part of your job and build a framework, build communication formats. This can be all hands meetings. This can be regular update emails. This can be personal one-on-ones, depending on the size of the organization. But you need to keep the team in the loop, make them part of it, and also create, I think, a very strong positive narrative of why is this better together? What's in it for you guys? And really like break it down to why is this good for you? And there will be, I guess, quite naturally, there will be situations where such deals are not good for everybody, and there are redundancies, and you need to let go of people. I think ideally you take those steps as early and as quickly and as clearly as possible, and just sort of create this message to the team of this is what we need to do. There's redundancies. We need to take those steps, and there's some hard measures too. This is what we've done now. Whoever's on board now will be on board. Like we are one joint team now. We need to sort of move this whole ship forward, and this is the strategy. And then create a very positive narrative around the sort of merged companies, and keep communicating this, keep communicating milestones, keep communicating successes, and try to get everybody behind this joint vision. I think this is absolutely key, and usually people don't spend enough time on it.
How early would you start involving your own team when you've, just made yourself basically the decision, hey, this is something I want to entertain?
I think this cascades. I think your sort of close circle, your senior guys, you want to involve relatively early. To also get their strategic input on what do you think. So they will have a much different buy-in into a deal when they've had the opportunity to at least give their opinion along the way, and like give their concerns or give their bullishness or whatever it may be, but just be part of it and be integrated and heard. I think this is super powerful. Obviously, this depends on how critical is such a discussion. Is there a potential leak? Does this potentially negatively affect my company, etc.? So you need to sort of weigh this versus how open do you communicate to the team. But the earlier you can, and the earlier you feel you can communicate to your team, and especially your senior leaders, the better. And really get them on board and get them behind the deal. The operational teams also sign off the business cases, basically sign off the synergy cases, the business case of if we buy this business in that market, do you sort of underrate it that you actually deliver it in Italy, in Brazil, in wherever? If we buy this, are you going to deliver those numbers? So they need to be behind this plan, and that means they need to be integrated early.
And on the leadership level, how do you decide who stays, who leads? How much do you involve kind of the CEO of the business that you acquire versus you yourself make the decision?
I mean, that's not easy. And like the acquired CEO's team and group, the CEO will always be emotional. This is his or her team. Like they're going to be, I hired those people. I think they're great. We absolutely need them. That would be the typical reaction. So I think you need to, again, try to be as rational and objective around that discussion. In many cases, I found there's actually complementary skills. Like in going back to the MeinFernbus, FlixBus example, we found a lot of complementarity in terms of they've been strong in certain functions and we've been strong in others. So in many cases, it was actually very clear which team would lead the future function. This doesn't necessarily mean that the other team is going to be fired completely, but we would try to define who's leading, and we had Munich and Berlin in those cases in this situation, but like which team is leading that function and who's in charge. Then you put the leaders in charge to build their organization again. And say like, whatever this may be, marketing, network planning in our case, finance, whatever, you just define this is the core, be it Munich or Berlin team, they will lead it, and then they ultimately build their organization along the way. And this may lead to, we reduce in one location versus the other, or like build up somewhere else. This may be the outcome. But I think, again, building this operating model and that future org chart is very, very important. And this is said very, very sort of complicated discussion on the CEO level that needs to be had. And if you have a good trust relationship, then I think this is doable. If there's lots of disalignment of incentives and no trust, etc., this is going to be very difficult.
Was the decision to take on the green back then a strategic choice by you because you were actually eyeing for something else in the negotiations?
Yeah. I mean, as said, our team was bleeding blue and their team was bleeding green. So they were very passionate about, this is our brand, this is our team, we're fighting for it. So this was super emotional and also very sort of psychologically interesting question in terms of what's the future branding going to be? Because also the founders on both ends were very committed to their brand and like the naming and the color and like everything the brand was and like the design and everything. So this is very complicated. We ultimately decided or tried to navigate it with a sort of Solomonic decision to say, well, guys, we're building an international business and MeinFernbus is not going to work in all other markets. So we need an international brand anyways. And this is how we in the first place came up with Flix, because we felt this works in so many languages and like the domains are available and like it's easy to pronounce and stuff. So let's just take Flix as a brand long-term at least. And in any new market, it's obviously going to be Flix, but we're happy to take green as we're committed to taking green as a color. So you keep the green and we keep the name in that sense, and everybody gets to keep something. And that's the joint brand and joint vision. What we never really sort of told the team is that we liked green anyways a lot, because it's like the sustainability effect of it is just great. And we were a bit annoyed that the color was taken before we even started. So we had to take blue back then because green was already taken. So eventually for us, the outcome was perfect. But the way to get there was actually more complicated. And we've had this interim phase of, we called it MeinFernbus, FlixBus in Germany for a while. And this was all this messy double branding and whatnot. I'm not sure if I would do this again in hindsight, or I'd rather have a clean cut to say, this is the decision, explain it to everyone, have a clear story internally, but also externally, and just have those clean cut and then just go. And again, in terms of bigger learnings that we've made along the way, all the decisions that you drag on that you don't take clearly at some point when it's actually clear what you need to do, but you kind of feel like, I'm not sure if I can take this decision already. That's usually a mistake. So if you have clarity on this is how the organization should look like, this is the person who should lead a certain function, this is the branding that we should take, this is the product feature that we should take from this or that part of the business or company, then just go and take it. Just make it clear, take the decision, and then just move on. This is all ultimately, even though this may be hard at the beginning for the team, it's ultimately going to be better because it creates so much clarity and just doesn't leave stuff in limbo and like leaves discussions open and like conflicts and burning and stuff. So taking clear decisions as early as possible is certainly something that you absolutely must do, especially in those integration situations.
How long did it take the team to really, adjust to kind of the new environment? How much time would you give a team to adjust to such a new circumstance?
In the Flix MeinFernbus situation, the Munich and Berlin teams, I felt the culture in nuances at least was different for a pretty long time. So you always felt a different vibe in Munich versus Berlin for a pretty long time. At some point we just accepted and said, well, it's just the case. Berlin is a bit different than Munich, whatever. Let's just commit to a certain sort of small set of core values. This is who we are. This is how we want to work. That's important to us. This is our core values. And we also made them explicit and just get everybody behind it and keep communicating it, keep stressing it, keep working on it, and then accept the nuances in the cultures. And I think this is also a big learning for us in terms of the future deals that we've done afterwards. There's always going to be a certain part of a local culture, a certain way of doing things locally that this team has been used to for many years. And that's basically impossible to manage out. There's also, if you look at sort of international cross-border deals, if this component comes on top, that makes it more complicated. When we acquired the Turkish business, for them it was actually great because there was lots of positive momentum. We had a big welcome of, hey, it's great that we have you now. You're the best owners. You understand what we're doing. This is fantastic. There was a lot of positive sentiment also towards us. And this was great to see. And we tried to use it to really keep it up and also sort of push the story to the team. Hey, we're very bullish about Turkey. This is great. The team is great. The momentum is great, etc. So keep this up. And a bit similar in the US, actually, where I felt the Americans, they're just very commercial and transactional. They said, okay, we've done this deal. Fine. This is the rationale. That's the new situation. Let's just move on from here. This was very commercial and transactional. At the same time, we've had a similar situation there where the organization felt this is a new beginning because Greyhound has been in decline for many years and undermanaged and underinvested and sort of in a very difficult spot. And they've been fighting their way to sort of defend their position and very proud of the brand and rightfully so. But sort of very difficult, I think, overall for the organization. So they felt like this is a relief. We now have a strategic owner. They really understand what we're doing. We're talking the same language, like deep in the commercials. They really understand us. And this created lots of positive momentum. And then again, with this sort of very sort of pragmatic commercial approach that the Americans have anyways, this was relatively simple from a cultural point of view to just sort of get into a positive working mode.
It's a cool segue into kind of the last part of our conversation. Now, integration can happen on typically on 3 levels, right? You have a holding company, you leave the acquired business as a standalone, you have selective integration where you integrate IT, finance, for example, the back office, and then you have the full absorption, right? One, you slap on the brand. You have done everything in hindsight. How would you decide how deeply you need to integrate?
I'm not a big believer in holding models, I must say. I think, of course, there's a few sort of public and private company examples where this has been very successful and lots of value has been created and stuff. I'm not a big believer, I must say. I think the biggest synergies come with deep integration, and that's typically been our model. Like, we've been a bit more to the middle model that you mentioned in terms of trying to sort of build back office and like sort of more like low-hanging fruit synergies early. But ultimately, our goal is always to fully integrate. We've only twice in the world we left the brand, which is Greyhound, because it's just so well known and like the brand value is just so big, and Kâmil Koç in Turkey, because Turkey is a very like culturally specific market where we felt there's lots of value in. Kâmil Koç was also a very old business. Like Kâmil Koç and Greyhound, they're basically all 100 years old. And we felt like, okay, let's leave the brand. But everything else is centralized. So it's one system, one operating model, joint and shared headquarter functions, back office functions, etc. So I think this is the most powerful model. And again, coming back to quantifying synergies, if you only look at the headquarter side of things, there's only going to be so much you can do. I think the more powerful part is when you're actually able to also integrate products deeply, sort of use the best features of both companies and integrate it into one better product. Basically build a joint go-to-market, a joint brand, a joint platform. I think this is where the real power is. That certainly doesn't sort of work in all the cases. And sometimes it's enough, or the synergies are big enough if you just create a joint sales force that can suddenly sell 2 products instead of only 1 to the same customers. And this can be a big lever. At least the Flix model, or has been the Flix model. For us, the big part and the sort of big value has always been in full and deep integration.
I think that's probably also in like a small business context what you typically see. But I would also not underestimate the brand value in hyper-local market settings, because brands are known in their vicinity. So before you make the decision to just fully integrate, understand that also in the context that you're acquiring.
Totally.
In that sense, what would you say are factors that operators consistently underestimate about the integration?
It ultimately comes down to really get this new joint company behind a strong joint positive vision and narrative, and really build this joint strategy that people are committed to, that are excited about, and that they feel that, hey, we're better off now, we're stronger now, this is great, and create this positive momentum in the organization. And with that, also manage all this cultural shift and all the uncertainty that will be there. I think this is the key part and the most complicated part. And this is where, as a CEO, you need to spend most of your time, because that the operational things, the technical, let's say, ticking off milestone stuff, this is what you need to delegate to your team as quickly as possible.
Is there something you would definitely touch already in, let's say, the first 90 days or even the first month once this deal is signed?
Absolutely. I think having early successes is also something that's super motivating and hence relevant and important for the team. Often we had signing and closing, and there was a certain time period in between where we could, to some extent, already talk to each other and exchange some information, try to prepare stuff. We try to use this time as efficiently as possible to create early successes on low-hanging fruit, to say, hey, this is what we've already done. This has created an uplift in sales by X. This has sort of made customers more happy. This has created more traffic. This has created brand awareness, whatever this may be. The earlier you can start basically reporting successes on it, the better. People want to be part of an organization that's successful, and reporting success helps people and organizations have a feeling of, hey, we are successful. So the earlier you can do this, you should absolutely do that. Totally.
As a closing question, Jochen, you've done a dozen plus deals, mergers with an equal, absorbing weaker competitors, buying yourself a market entry. If you could send one piece of advice backwards in time to yourself on the morning of the first acquisition, what would it be?
That's a difficult one. First, it's a long time ago. Second, I guess it's actually quite helpful to talk about it, because you usually forget what you have learned along the way, what's sort of clear to you now, what's not clear to most others who haven't done it before. But I think the key part is really to build this trusted relationship with the other side. This starts at the top, starts at the owner CEO level, and then triggers down. this is where you probably, over the course of the entire process, from deal origination to deal making to sort of signing, closing, the legal, technical, nitty-gritty work, and then to the integration side, this is where you usually spend not enough time, but focus on this is little risk that we need to manage, and we need to put a nasty clause into the contract and try to sort of manage all your risk. I get early piece of advice. If you're not in love with the deal and the target, you shouldn't do it. Very clear. And also, this needs to be on both sides. If you don't feel love and affection from the other side too, at least to some extent, you shouldn't do it. If it's not clear that this makes sense, just leave your fingers off it and just don't touch it. But there needs to be this clear logic and this clear match very early. If it's not there, just don't do it. And then spend time to really build this trust, because ultimately, I think trust is such a strong catalyst for managing problems along the way that you can't really overestimate the value of it. And this is super valuable. The nitty-gritty warrant level clause 17.3, that's not going to save you if the deal is shit.
Thank you so much for taking the time, for sharing your learnings, and I really appreciate your support. It was great to have you on the podcast.
You're most welcome. This was fun.
Thanks, Jochen.